want to start off the show, of course, as normal, with a summary of kind of what I saw happening this week. And here's the S&P 500 since the beginning of last year. That was our peak last year on the 4th of January. Kind of had that red line there that showed the trend. And one of the things you look for is which way is the primary trend. And one of the things we look at is, are the peaks higher or lower? In this particular case, the peaks have been lower all the way through last year, kind of connected by that red line. And so our current signals are, our stock market signal is green. Why don't we show those, Brian? And there we go. So the way that this works is that we have kind of this process in the background, an algorithm that we've created to kind of take a look at multiple different inputs. And we have a fast and a slow signal. So what that really means is that kind of we're looking at things that are happening on a shorter term basis or a longer term basis. And we use the fast signals to really operate some of our transitions and trades that we do inside of our IRAs, Roth IRAs, those type of things. We don't have to worry about tax consequences in those scenarios. We use our slower or longer term signals for our taxable accounts. We don't want to generate as many trades as possible. Historically, on a backtesting basis, fast has a better rate of return than slow. That's why we use that one in the IRAs, for example. Now, our bond market signals are currently yellow-green. Let me show the bond market signals. There we go. And so we've got a scenario here where a little bit of caution on the bond market here in the short term. And we've made some adjustments to the portfolio. And what we're doing there is we just essentially want to be in a scenario where we're a little bit shorter term, or inflation protection securities and those types of things. And so if it's green, both for bonds and stocks, we're fully invested. Sometimes we'll use things that have more motion than the market, so we can maybe participate even greater on the upside. If it's yellow, we pull back and get more defensive. If it's red, we'll often get very defensive, sometimes even to the point of moving into, kind of T-bills and things like that. So just to kind of explain that. And so let me make this a little bigger so we can see this. And back to my concept about primary direction here, you can see now, since the bottom that we hit here in October, we had a high that came up right to the red line, and then we hit a second high that was higher for the first time. We hit another new high in this particular motion, and that's a big deal. And then we started back down. We've got below the red line, not too long ago here, and then we started up again. And so things we look for, like a checklist. We want to establish a new high that's higher than the previous. Did it? We want to get through the red line, the trend line. Yeah, we did that. We even held it again. We want, when we do fall back down and retrace, we don't want to go below the low that's right above my head, right? We held that, which is great. We want to get through the 200-day moving average. We did that. We want to see the 50-day moving average come up from underneath the 200-day moving average. That's called the golden cross, has a really good track record for predicting direction. That has happened and held. And then the next things we want to see now is we're about 1% away from establishing a third new high from that low in October. We're almost there. And looks like we might get there. So we'll see. So that's going to be what we're watching for next week, is how that plays out. Then I think maybe the last thing on my checklist is we really are in this giant range. If you look back to where we are now and go back, May of last year, we were at the same place. And so really 11 months we've gone sideways, but we got this huge range. So the last thing to say, we're now in a directional change, primary direction up. We're not sideways, which is pretty much where we are now. We're not down, is to break out of that range, which is about 4,300 and change, and that high that we hit back in August of last year. And so, we're not too far from that. We're at 4,100 and change now. So this is what's happening here. And so, of course, we're in the middle of all of this negative articles. Oh my gosh, I've never seen so many about how everything's going to fall apart in the banking system. And they might be right, but the market is going up. It's been going up since October. And you do have to pay attention, I think, personally, more to what the market is doing than what they're putting in the article. Right? I mean, somebody's making a projection. It might be somebody we really, think is very good about making projections. But the market is making a projection here that things are, looking good. Now, it's not always right, but it's more often right than the articles, in my opinion. Because right now it's about 10 to 1, negative to positive, which isn't completely unusual. In 2020, when the market was skyrocketing up, it's one of the greatest markets I've seen. There was a lot of negative articles all the way up. Negative sells, right?
Yep.
It gets more clicks. We could get much more views on this show if we talk doomsday constantly. And we try to be somewhat balanced, but certainly actually skew to the positive side a little bit, just because of the fact that I want to offset some of the negative, especially with my clients. And so what we have here is this potential directional change that's going along. We do have to pay attention. The banking crisis seems to be behind us, but it really isn't, because the banks are probably going to be cutting back on their lending.
Yep.
Right? And that's a way of kind of contracting the economy in and of itself. There's concerns about this inflationary pressure on earnings themselves. Because, if you keep having your costs go up as a company, as long as you can keep to raising your prices, you're okay. But eventually that doesn't happen. There's a price elasticity that kind of hits a ceiling, and then your costs can still be going up, and all of a sudden your profits are starting to get squeezed.
When demand hits that point where they just don't want to pay anymore.
Yeah, exactly right. And I don't know that we've seen that dramatically yet, but we're starting to see it. Definitely. There's a lot of pent-up demand and a lot of money. People refinance. People got money from the government during the pandemic. The job market is still very hot, those type of things. So wages have been going up, not as fast as inflation, unfortunately, but going up. So households and businesses are in pretty good financial shape as a whole, right? So that's what's kind of driving on the demand side. And it really, the battle between, is that demand going to be enough to keep us out of a recession, or at least a deep recession, or not? Is the demand going to collapse in order for us to bring down inflation? Well, I'll call this inflation week, right? Because what we had from this week was a report on the CPI, right? And we'll cover that first. So CPI is a basket of goods that they look at to determine, how much did it grow, in this case, year over year. So we're looking at, essentially March of this year versus March of last year. And you can see there it's 4.99%. That's a pretty good trend. I'm showing the last 3 years.
Yep.
2 years, it went from basically 0 to peak out in July at 9.1%, okay? And now we're kind of coming back down. So a lot of people ask me, when do you think it might get down? Inflation's really hard to tell. But on a pure pattern basis, it would be reasonable to expect it to get back down as fast as it went up. I don't see it collapsing, although that can happen, especially if the economy starts to fall apart. But took 2 years to get up, could take 2 years to get down, July of 2024. That actually sort of fits in with the statement of economic projection that the Fed puts out 4 times a year. They're looking at, that kind of end of first half 2024 to finally getting back down to this 2% rate. Now, keep in mind, the Fed talks 2%. They're not talking about CPI here. They're not talking about anything except for core PCE, which is already in the 4% range right now. And we'll be talking about that in a couple of weeks, because that report's coming out at the very end of this month. It's very late. It'll come out for March. But the trend is good, right?
Yep.
This was a good report. Now, the problem with this is this basket includes food and energy, which the Federal Reserve, for the most part, ignores food and energy. Not always. They've made some comments sometimes, but generally speaking, they look at what's called core CPI. And so core CPI takes out food and energy. That pattern doesn't look quite as good.
A little bit more sticky.
Yeah. And so now it did peak out in September, so it's a lower, but it's not that kind of smooth dropping scenario. And the reason is because of what's in core is the things that we're starting to buy, services, rents, and those types of things are part of this. So, that was I'd say that was a negative for this week. It didn't drop as much. You can see it's actually have a little swale here recently.
Yeah, and you can see it's higher than actual CPI.
Yeah, that's right. And that's kind of interesting too. So that's one of the pieces. Now, the thing that came out yesterday that really drove the market was the PPI, right?
Yep.
So this is a producer's price index, kind of wholesale prices. And that trend looks fantastic. It actually peaked out in March, not in July, so it peaked out earlier, and it's coming down really fast. And it's all the way down to 2.75%. Matter of fact, it actually was negative for the month over month. March of this year versus February of this year, and so that's a good thing. This is why the stock market is hanging in there and doing pretty well. We are seeing, I think, some trends overall in inflation that are pretty good. And so the expectations is that we would see, a quarter point increase on the next meeting, which would be May 2nd and 3rd, announced on the 3rd. And by then we'll have some more info. We'll know what the PCE inflation number is by the end of the month. But the market is betting on a quarter point increase right now. And, interestingly enough, the market is actually also betting on a decrease of interest rates by about 0.5% on the federal funds rate by the end of the year. So that's not what the Fed has said that they're going to do. It's not in their statement of economic projections. Their statement is they're going to go up one more and stay there, right? Yep. And that changes, but that was for their last one. And they're going to stay there all year. And so this is where there's been some disconnect between the market and the Federal Reserve. And that's somewhat the scary part, because the market sees something, and the market tends to be fairly accurate, more accurate than the Fed. And so if the Fed doesn't see the same things and then holds up rates too long, you could have a harder landing, recession-wise.
Can the market still do well by holding at 5.25?
Yes, it can actually. We had the greatest run in the stock market history in 5-year period was 1995 to 2000. I believe the Fed funds rate was in the 5 to 6% range for most of that run. And I'm just recalling this off the top of my head, but yes, definitely. There has to be some things going on that work. Now that was not a high inflationary time frame, so that's what's going to make it difficult. So that inflation kind of moderating the way it's doing, and I think direction is super important as far as that goes. So that's what's going on. I think things are better overall than they seem. If you read the articles, that can change. We'll change with it. We have our system of triggers, of fast and slow, stock, bond, etc., and we respond to these things. We have this debt ceiling issue that's coming up, right, that we'll have to deal with. There's things that we need to be aware of and to respond to, but I'm just trying to kind of push back a little bit on some of the things I'm seeing, in the articles as far as that goes, and really pay attention to what's happening to the price of the stock market. So I read all these articles too. You should also, if you're really interested, but make sure that you balance those out, because again, it's 10 to 1, right? Negative to positive. So if you read all the articles and you read 11 of them, you're going to have a pretty poor outlook on what's going on. That's not a balanced outlook, and that's going to make you, in my opinion, a worse investor, right? You need that kind of balance. You have to hunt for the positive, find the negative quite easy. I think that's what we provide here, by the way, is some of that positive information. All right? Good.